or any other phenomenon that we generally observe, you sometimes get an over swing in one direction or the other. So coming back to your point about the bots, I completely agree. I mean, I actually launched my business to compete with a Paris-based, I probably shouldn't name them, but a Paris-based newsletter service which auto-generates most of its content. So from the first time I reviewed their product back in 2010, when I used to work at NYC Life, that was a period where they were pitching us their product. And after one read of a sample newsletter piece of theirs, I realized right away it was auto-generated. Anybody who's a native English speaker would be able to pick up on that. And not only was it auto-generated, which by itself isn't necessarily a bad thing, I felt it just lacked nuance in its interpretation of technical analysis. It was a little too template-driven, too cookie-cutter. Obviously, that was 2010. We're in 2019, late 2019 at that. So technology progresses, and I'm not saying that it's never going to reach that level where human readers won't be able to distinguish what they write from what I write. But at this point in time, and actually at the time I launched my business and still to this day, I feel that there's a lot of value that many of my readers at least will find in just being provided something a little more nuanced in the interpretation. A lot of the bots actually, even I mean, we can talk about bots perhaps even in an entirely separate podcast, but I would say this: a lot of the biggest hedge funds who employ teams of PhDs, quants, working on their own quantitative strategies, and I'm not saying all of them, but quite a few big names every now and then do experience the wrath of a black swan, and the bots really have no way to account for such moves outside of the ordinary, let's just say.
Yeah. And in your perspective, what are some of the new market trends looking like across the globe, right? Where are the major players that you've mentioned early on just now is where are they moving their money, and, how are they responding to, let's say, Donald Trump's tweets, right? He tweets a lot, and, it could whiplash, across the market depending on his tweets.
Yeah, that's very true. As a matter of fact, JP Morgan just came out, I believe it was JP Morgan, that came out with an index to track the impact of Donald Trump's tweets. So obviously a lot of people watch or wait with anticipation for his announcements, although a lot of them are very randomly tweeted out. So I guess one of the big flows that I'm seeing, obviously, right now with all the uncertainty around the geopolitical situations in various hotspots around the world, and with this U.S.-China trade war very much at a fever pitch, a lot of them, I guess, a lot of the momentum in recent months leading up to just the past month, but not including the last couple of weeks, would have been to go into fixed income instruments, markets that pay a steady coupon or perhaps have a implied yield. And what we've seen in the last couple of weeks, week and a half to 2 weeks, is a bit of unwinding of a lot of that. So we had a real stampede into a lot of fixed income instruments where basically there was a race towards negative yields, even within the U.S. Treasury market. So I'm not saying that they hit negative yields necessarily. I'm just saying that they were trending in that direction, following in the direction that the BOJ had taken, or that the ECB had taken, and then thereafter all the corporate bonds within those two regions. And so what I guess we just have witnessed just in the last couple of weeks or so has just been, I guess, a really oversold bounce, oversold in the sense that the yields had just gotten too low. And so, if you're to look at the price of the fixed income instruments, and obviously they've been selling off in the last 2 weeks. But nevertheless, there's still a very large increasing consensus that yields in the U.S. are headed lower. However, we must always bear in mind that when too many move in a herd-like manner, you usually get the opposite type phenomenon. So, being a bit of a contrarian myself, I actually do feel that the fixed income markets, regardless of this recent 2-week unwinding or correction, if you will, is still very much vulnerable to a much bigger bubble burst down the road.
You brought up a very, very good point in regards to the geopolitical tensions that are going on in the Middle East. And to add to that, when it comes to the geopolitical tensions that are going on there, as well as the U.S.-China trade war, and on top of that, the crisis in Hong Kong, where do you see the major players moving their money today?
Well, a lot of people I spoke to just last week, I was at a couple conferences, but one of them was related to blockchain and crypto. And so a lot of the individuals I was speaking to, although quite vested within the crypto space, just via their employment or their businesses that they're involved with, are fairly bearish on Bitcoin in the near term. What I would say, though, is that was a largely, you could call it a retailish crowd, not necessarily professional trading crowd. These are more sort of builders of blockchain related businesses, and so a lot of them actually fear that Bitcoin's about to take a bit of a dive, just because we have an upcoming significant market moving news event. September 23rd is when my former employer ICE launches backed BAKKT.
Right. The Atlanta-based company, correct?
That's correct. Yeah. And so
trade Bitcoin. They trade, if I'm not wrong, they trade Bitcoin futures right on that platform. And what other offerings do they have? Do you know by any chance?
Yeah. So BAKKT hasn't launched yet, but when it does on September 23rd, in about a week or so, it will have Bitcoin futures, which are physically deliverable. So that's to contrast with what we have on the CME. The other sort of traditional futures giant, the CME, just for the audience's background, in case they're not aware, is actually the world's biggest exchange group. Okay, so they're number one, and ICE is number 2 globally in terms of its market value, the market cap of its shares, and so these two giants have been going head to head on a variety of products throughout their entire history, and this backed launch, this BAKKT exchange, which launches September 23rd, this will be the next sort of battle between the two giants. So I do think actually that those from the crypto space who I was speaking to last week, who feel Bitcoin's about to take a dive down, similar to what happened when the CME Bitcoin futures launched December 2017. I actually think the opposite's going to happen this time. I think the market's going to go higher. And why I feel this is just due to all the investment I see in the industry happening. I see a lot of good projects, a lot of good technological innovation happening around a variety of blockchains. Right. And I'm not just saying, I'm not speaking specifically on Bitcoin's blockchain, right? I mean, there are loads of very compelling, more scalable projects happening all around, and Bitcoin has its role to play. It's more digital gold, in my opinion, more a safe haven play than a blockchain to use for making payments, for instance. And that's not to say that it can't someday be used for payments for certain products, but I just don't think you would ever use it to buy coffee, for instance. Right. I mean,
Not yet, right? Not yet, at least.
Not yet. Well, I would be really poor if all of a sudden I was using my bitcoins now to buy coffee. Yeah, let's hope that day doesn't arrive, because it's still trading nicely above above the 10,000 level, and that's a psychologically key level that a lot of people are watching, and I would encourage everyone to mark their calendars for September 23rd. I do think that we're going to have a bit of an additional move, and obviously there's always a chance that that prediction doesn't pan out, but I'm kind of formulating that based on a lot of conversation with the institutional contacts of mine, which is really what Backed is being launched for, right? So it's really geared towards the traditional futures
Institutional investors.
Correct.
Right? I think to close out the call with one last question for you, just quickly focusing on the European markets and what's going on with Brexit. And European markets today, right? You see there are a lot of negative interest rates, right? People aren't wanting to leave their money in banks.
Yep.
And people are referring to other methods such as throwing their money in venture funds or running and throwing it into crypto. What are your thoughts in regards to that? How is it affecting what you're doing today? And how do you see the markets fluctuating in that regard?
So with low interest rates, it's impacting obviously a lot of pensioners, a lot of pension funds, those longer term buy and hold type of investors who have been counting on yield for their retirement, etc. The low interest rates really don't affect me personally. I'm not really invested in fixed income as a buy and hold type investment. I sometimes trade fixed income futures, but that's very different from trading or rather from buying and holding a fixed income, a bond, for instance. And so I guess with respect to my business, there is no impact from the negative interest rates. In fact, some of the volatility which I'm actually anticipating on the back of any real disruptive unwinding of the fixed income bubble, that'll create great trading opportunities for somebody who's nimble and who's able to short those fixed income futures as the bubble pops. But in any bubble, it's very hard to actually pinpoint exactly the ultimate peak or top of the market, and so it's probably better to just take a wait and see approach for now, to not be the first to stick your neck out, because these bubbles they have a knack for lasting longer than some of us can stay solvent. So I'm not making any recommendations in this podcast. I just want to be clear. What I'm sharing obviously is really just to give every listener food for thought. But the fixed income market is quite clearly one of the biggest bubbles staring at us right now.
Right. Okay. Well, Darren, thank you so much for joining us on today's podcast. It was lovely having you. We hope that you can join us for future episodes down the line. And last and not least, what is the best way to contact you via email for our listeners out there who might have more detailed questions for you?
Yeah, I'm easily contacted just through Darren Chu at tradablepatterns.com. So that's DARRENCHU. So my first name, last name, the @ tradablepatterns.com. So I use a US spelling for tradable just because most of my clients are in the States. So that's TRADABLEPATTERNS.com. And for anyone who's curious about my website, you can just take that domain extension of that email address, tradablepatterns.com, visit it, and feel free to add yourself to the free mailing list. There's some free content, and it's very educational. So hopefully your listeners will find it helpful.
All right. Thank you so much, Darren. Thank you very much for your time.
Thanks for having me, guys.
The podcast you just heard was made using Anchor. Ever thought about making your own podcast? Anchor makes it really easy